It's Thanksgiving weekend. I hope you had a great Thanksgiving and lots of turkey and still probably lots of turkey to eat. So, but anyway, again, appreciate you being here. And what we're going to dive into today is how to trade for basically kind of market neutrality. So this is we're going to go through an offense defense strategy that'll really give you a great edge. Totally different kind of way to trade that you may not be familiar with, but it's a really a great strategy to add to your trading portfolio if you're not already trading pairs. So this is kind of an interactive workshop. So just make sure that if you have any questions, feel free to ask, and we'll take it from there. So what we're going to talk about here is pairs trading or spread trading, and basically this is kind of where hedge funds got their name, hedge funds, because they're long short. So that's kind of the strategy, long short strategy. So but before we get rolling, and just a little background on myself, I've actively been trading the markets now for about 40 years, which I have to really pinch myself thinking about that. But started my career back in the 80s with a company called Coastal Corporation. It was a integrated oil company with refining and pipelines, all that kind of stuff, headquartered out of Houston, Texas. I was able to get into their trading program they had. They would actually train you back then to trade crude and oil products, and then add you to their supply team and their trading team within the company. So got my foot in the door there, and was able to get into that program. They sent me down to one of the refineries down in Corpus, Texas for about 3 months, and really great experience. But that really kind of gave me a good foundation of the oil markets, how you're bringing in the crude into the distillation units, and producing products and gasoline, fuel oil, things like that. So it gave me a really good fundamental foundation of how things kind of worked. So went through that, ended up in the shipping department, chartering tankers, scheduling, doing all that kind of good stuff, and then eventually got into the crude oil cargo trading side at Coastal, and was there not too long, and they sent me out to Singapore for a couple of years, which is a fantastic experience. Traded products out there, and Asian crudes, and then went to work for a company in the mid 80s called Trans World Oil. At that time, they were the largest oil trading company in the world. It was Trans World Oil, Fibro, and Mark Rich were the three big oil trading companies, and we were really in all the markets, just really large positions. And we're going to talk about some of the things that we were doing back then, which were pretty much built around pairs trading and spread trading. So we'll go through some examples of how these things work and what we were doing back then, and things that you can apply today. But that was really a changing part of my career. Fantastic. Ended up working there for 17 years, and ended up in their corporate office they actually had in Bermuda for 16 years, and ran the international trading desk out of there for 10. So that's kind of where I really cut my teeth on these kind of pairs trades and option trading, all that good stuff. And just kind of want to pass that on. And we're going to get started talking about pairs and how you can incorporate this into your trading portfolio. So the following presentation today is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. Now, why would you trade pairs, or what are pairs anyway? So let's say, for example, the S&P 500 falls 20% the next year. How's your stock holding performance going to hold up? Or, how are you going to perform if that was to happen? Or let's say the S&P 500 climbs 20% in the next year. Then, how will your stock holdings perform then? But what if you had a trading strategy that would allow you to make good money, even really great money at times, in either of these scenarios? So you could win in a bull market, or you could win in a bear market. So, either way, you can have a winning strategy doing this type of pairs trading. Well, there is such a strategy, and it's what, basically is kind of known as a kind of a market neutral strategy that uses pairs or spreads for all the trades that are taken. Now, so in other words, a pairs trade is going to be equally likely to profit whether the market you're trading, the broad market you're trading, goes up, down, or sideways. Or the strategy, what it does is it matches a long position with a short position in a pair of correlated instruments, such as could be two stocks, it could be exchange traded funds or ETFs, or it could be a stock versus an ETF, or it could be currency pairs or commodity pairs. So pairs trading, then what it does, it looks for either strength or weakness in a correlation of two pairs, and then it's going to go long the technically stronger security while simultaneously going short the weaker security closing position as that relationship starts to return kind of to its statistical norm. So the strategy profit is derived from the difference in the price change between the two instruments or spreads that you're trading. So that's the beauty of it, the spread, okay? So it's basically a market neutral trading strategy that seeks just to neutralize certain market risk, systemic risk, overnight risk, by taking offsetting long or short positions in an instrument with an actual or theoretical relationship. So, what you're doing is you're playing the spread relationship, that relative value between two pairs versus the broad market. So it really, pulls out that kind of systemic overnight potential risk that you might get. So as long as the stock or security you buy then outperforms the security that you sell short, you make money. And the bigger the outperformance, the more money you make regardless of market direction. So this really makes a pairs trading strategy a fantastic way for you to make money without taking broad market risk. And we see so much of that kind of broadside risk that can come out of nowhere, right? It's kind of like that black swan event, and you'll never know when it's going to happen. But if you're just playing relative strength between two correlated securities, you take a lot of that out of the potential position, getting harmed by that. So that's the beauty of the pairs trades or spread trades. So let's go through a couple of other reasons to trade pairs. So first of all, is risk management. So by trading pairs or spreads, this can really help to mitigate, overall, market risk by simultaneously taking opposite positions or on a related security. You then can reduce that exposure to the broader market movements. So this is really useful, in a high volatility market or uncertain market when we're, uncertain and you have sudden swings that can lead to, really significant losses. You can see we've been, pretty fortunate so far this year with a pretty decent trend to the upside. But sometimes, you get these pullbacks that can come out of nowhere based on some news that you couldn't see coming. And all of a sudden, the markets are down 3%, 4%, 5%, and then it even gets worse, right? So it's a really good way to risk manage, mitigate risk that way. Now, the other thing is sector rotation. So you can utilize pairs or spreads to exploit trends in specific sectors of the market. So for example, recently, we had a really big sector rotation kind of in Google versus the other parts of the market. So we'll look at that. But that can be something that happens. You get these kind of massive sector rotations into a certain security or certain ETF sector. So for example, then you could go long that security in the industry you expect to perform well, say for example, Google, and short a security in an industry you expect to perform worse. So it could be Google long, it could be NVIDIA short, something like that. So you can trade all these different types of different structures or combinations. And also then hedging. So, traders and investors can use pairs or spreads to hedge against potential losses by taking positions in a related security that tends to move inversely. Then you can really help to offset the potential losses in one security with the gains in the other. So this is, what the big hedge funds will typically do. They're long short. They're looking for, big sectors that have potential, growth or upside or good alpha or maybe higher beta, and then they'll offset the risk with something that's kind of related to it. So it's a great way to kind of hedge out your position. And then also diversification. So by trading pairs or spreads, it's going to allow you to diversify your trading portfolio across different securities while still maintaining a focused strategy. So it can really help to spread the risk around and enhance your potential returns. So be thinking about, what you're going to be seeing here today as kind of a combination of something you can add to what you're already doing. Or, over the years, I've taught this course and I've had, members and clients that have done this, and now that's all they do are these kind of pairs trades because they just like the mitigation of risk that they get from it. So a lot of different ways that you can utilize what we're going to cover here today. So before we get any further, though, let's take a current market kind of overview and take a look at what's going on. I thought that'd be a good place to start. So first off, this is kind of what I call top-down kind of market analysis. So we're going to be looking at the big picture first. So this is something, back when, I was running the trading group at Transworld, we'd always do kind of this market top-down analysis, very frequently. And what we'd do then, we didn't have really good chart setups and everything. It was more on the fundamentals. So we'd look at the macro big picture, economic picture of oil or whatever we're trading, and then look at that picture and say, okay, based on the fundamentals, are we in an uptrend or downtrend, things like that. And then we break it down to the lower time frames, into, just quick intraday trading, that kind of stuff. So, looking at the broad markets and using the S&P 500 SPX, you can see this is a monthly, which I refer to as the macro. We're in a really strong sustained uptrend. You can see just based on moving averages as a trend, kind of a trend line, automated trend line, you can see this is the 21 exponential moving average, that dashed yellow. You can see how strong this trend has been since back in 2023. You can see when it really started right here was sideways, and then it started trending. And it's been a very, very strong sustained trend. We've only had, kind of one pullback that was below this back this 21, and that was back there in April, based off the first part of the tariff news, which, freaked out the market and regained back. But you can see how strong it's been. That's been following that 8 exponential, just super strong macro trend to the upside. I also like to use my momentum to measure momentum strength of the market. So things look decent here from the macro standpoint, first off, and then we break it down. We kind of lower the altitude, 30,000 feet. Now we're going to kind of swing down to about 10,000 feet. So let's go to the weekly or long-term time frame. And here you can see a good sustained trend. You can see back in April what happened. We came down, we broke down hard, and where'd we go? This is the weekly long-term, okay? So we came down. These are some key moving averages that you might want to use in the future. So that solid yellow is the 150 period moving average. The solid kind of blue teal is the 200 period. So you can see a really good strong support down there at those two moving averages. And it came down, and then, back she goes, back over that 50, and been trending pretty nice. We had that one pullback last week or 2 weeks back to the 21, but held the 21 and now back up. Looks like we're going to be headed back to those all-time highs and probably have a potential to break above that. So that's a current, kind of view there. And then breaking it down to what I call the daily medium-term time frame, you can see where we are on that. And this is where we can, where I really like to use momentum to kind of help forecast cycle direction. So you can see here just this trend we've been in, been cycling sideways here, then we trended back up, but it's been holding that 50 simple moving average really well. We had that break, back last week below it, and now we've regained above it, which is a really positive technical thing based on getting back above and having a number of closes above the 50. So we've had 1, 2, 3 closes back above that. We should be, a high probability to go back and retest those highs, and I think make new highs. So that's kind of what we're looking at currently right now. And then the next thing I always like to look at is, what is the seasonality doing? Is it going to be, helping the markets or kind of a headwind? So right now it's a good tailwind, and we'll take a look at that. Oh, you just left Bermuda, the Princess? Okay. Wow, good. I hope you enjoyed it. It's a beautiful place. So that's kind of an overview there. And then let's take a quick look at seasonality, and then we'll move forward. So currently right now, we've got a, pretty decent seasonal trend. When we get into that November timeframe. November, July tend to be seasonally the two strongest times of the year. So you can see we're right about here on the seasonal time frame. This is the March S&P 500 seasonality continuation chart series. And so we tend to get a really, decent seasonal trend all the way from October. So we're right about there. Now we do get a little bit of a potential pullback here about mid-December. So we're coming up to that shortly. Okay, so some of that is attributed to tax loss selling. So be aware of that. It's been a pretty decent year to the upside, but there will be probably some tax harvesting. So you could tend to see that right before the end of the year. So this is, the tendency there. You can see a little bit of a pullback in here. Then you get that Santa Claus rally, right? So that's kind of what we're looking at potentially there. Seasonality though right now is to the, as a tailwind, good for the market. And then here's the NASDAQ 100, very, very similar. We're currently right about here. And we tend to get that seasonal kind of little bit of upside pop, right to about the 6th or a little bit later, and then a little bit of a pullback. So that's kind of a look there on the two key, S&P and the NASDAQ 100. And then crude oil energy is seasonally very, very weak all the way to when we get into towards the end of December. Then you get a decent Santa Claus rally on the oil side. So when you get it towards the end of December, but right now it's pretty much a choppy mess. It's not, it's pretty headline driven as far as what's happening on the energy side. So that's a quick look there, on seasonality and just kind of a market overview. Okay, now let's take a look then at how these pairs trades work. So first you want to identify two securities that have a historically strong correlation in price movement. So these securities could be from the same industry, sector, or market. So the correlation indicates that when one security price deviates from its historical relationship with the other, there might be an opportunity for a pairs trade to take advantage of that discrepancy there between the two relative values of those pairs. So the correlation then has to do with how a pair then moves in the same direction at the same time. So statistically, these correlations are measured by either a +1, which relates to a highly correlated pair where they are, move really pretty much in sync, almost identical, to a -1 where, one's asset it might be going up and the other is going down. So they don't really have a good relationship to each other. Now, when you look at two stocks or indexes as a potential pair, you typically, what I look for is a kind of a correlation percentage or a ratio of about 70% or higher correlation between the two. Okay, so that's a really good place to start. So if the correlation though is lower than that, then the relationship between the two securities may be kind of too weak to kind of have a good judgment on what they can potentially do. So here's an example of what a pairs can do for your trading. So you can basically make money 5 different ways. So let's say stock A and stock B are highly correlated. Now, and so we could put let's say Google maybe, or Nvidia, or it could be Google to its ETF sector QQQ, or to its sector XLC communication. So it could be something like that. So we could use that as an example. So let's say Google, stock A, and stock B maybe is Nvidia. They're highly correlated. Now, if that correlation weakens temporarily, then stock A can move up. Let's say it moves up, and stock B might move down. So a pairs trade then might be able to exploit that divergence between those, the long stock, which say Google, and the short stock could be Nvidia, the underperforming issue. So you can see then the spread. So here's a 0 point. They both start at the same price level, let's say. So let's say Google is trading at $100 or something like that, just for making it simple. And let's say at that same point in time, Nvidia or stock B was trading at 100. Then all of a sudden you get a really big surge. It could be a catalyst of something that creates that surge. Whereas we saw a couple of different big major catalysts for Google last week, over the last 2 weeks. And then it starts moving higher. See stock A, starts trending. Now what happens in this example, stock B starts trending to the downside. So see how that spread widens? So here it is at zero. Let's say they were both $100 starting out. And now you've got stock A, it could be $150 up here. And then stock B could now be 50. So you can see that spread is super wide. And that spread has gone from, you know, parity to $200 difference between the spread, okay? So that's how it can work. And even the markets could be going down, and this relationship, you know, is creating this pairs to move in the favor of stock A, and you're still making money, even if the broad markets you're trading are going down. So that's the beauty of it. All right, so pairs trade is a great example of how that works. Now, central to the pairs trading is the idea that the two stocks or security or instruments, they're correlated enough that any changes in the correlation may then be followed by a reversion to the pair's mean trend, eventually creating that profit opportunity. All right, so then eventually that correlation comes back in to some degree. So, you know, correlations of, you know, 0.7 or above are often a really good benchmark, you know, to use for trading. That's what I've always kind of used, around a 70, or it could be a little bit, it depends, but a 70 is a good benchmark to start with. Now, here's just a look at one of the tools that I use, a correlation calculator. And I'll be doing a course, just to let you know, next weekend on this in much more detail, which I'll then go through in greater detail how to use this calculator, you know, for the correlations. But here's just a good example. So here's stock one, which is, you know, I put in here Goldman Sachs, and stock two, I put in JP Morgan. So you can see with this correlation tracker, just this right here, you can see the correlation coefficient is 0.912. So very correlated between the two securities, right? Within the financial industry, you know, et cetera. So it makes sense, right? So you can see here, this is Goldman Sachs is the blue right there, and then you can see JP Morgan is the gray. So you can see these correlations falling apart. Right here's a good one right there. So you can see here, let's say Goldman Sachs here is just going sideways, but look, JP Morgan's going down. So you can see that spread changing. So that's you know, what you can take advantage of. So in this example, you know, the markets are probably going down, but Goldman Sachs was just staying sideways, but that JP Morgan was going down. So that spread's widening in the favor of Goldman Sachs. So you'd be making money if you had that spread on, for example. All right, so that's your coefficient there. They're very closely related. And here's what it looks like on a spread chart, you know, just to kind of give yourself a more visual. So here's Goldman Sachs, and we're going to do this one-to-one relationship, you know, one share versus one share, or 100 shares versus 100. So kind of equal one-to-one relationship. So you can see the spread. This is kind of what we call a line chart. Now you can see here the momentum. This is what I like to use, and in the course, we're going to use a momentum indicator that I really kind of designed for spreads. So you can see here the momentum between the spread. This would be Goldman Sachs long and JP Morgan short. You can see at this point it breaks down, and Goldman Sachs is going down in value, and then Goldman Sachs, you can see the spread goes up. Okay, so this is kind of, you know, how that works, and you know, what we'll be getting into in much greater detail to show you all the tools and stuff that we can use next week and going through this. Now, this is the really cool part of, you know, trading pairs or spreads, and they can make money and go in your favor, you know, several different ways, basically 5 different ways. So think about it, if you're, you know, a long short player, you know, and you want to, you know, go long and trade something from the long side. So the only way you're going to make money is if it goes up. So if you buy stock A and the market goes up, you make money, but if the stock goes down, you lose. Now, if you go short, the only way you're making is if the market goes down, right? But if you're playing pairs or spreads, you can basically make money 5 different ways. So you can make money, let's say Google goes up faster than NVIDIA. Okay, or let's say just we'll use QQQ, which is the overall kind of ETF that Google is within, right? So and correlated to that. So let's say Google goes up more or faster than QQQ. QQQ is kind of going down to sideways. Well, you know, you can see that spread widens, Google makes money on that spread. Or you could say the long, Google's, let's say, goes up and QQQ goes sideways. You can see the spread increasing, right? See that spread widening out? Or let's say Google goes sideways and QQQ goes down. You can see that spread widening out. Even if Google's going sideways and the broad market's going down, you're making money. Or let's say the long declines more slowly. Let's say that's, you know, Google. So Google's going down, but QQQ is going down a lot faster. You can see the spread is widening. Or, you know, Google goes up, QQQ goes down, or whatever you're, you know, matching the spreads between. So those are the 5 different ways. Now, obviously, you can always lose. You can get the spread, you know, correlation, not the correlation, but the spread relationship wrong, and you can lose, right? So there's no, you know, free lunch. You know, you can still lose on these things, but this is just an example of 5 different ways that you can make money off of, you know, picking the right kind of relationship or pairs. So pairs then trading also, the other really cool thing, and this is another thing we're going to be really diving into next weekend, is how to do these trades using synthetic pair structure. So by using a synthetic long and a synthetic short, which basically mirrors or replicates the underlying stock or security ETF position that we're going to pair together. All right, so instead of just having to be, you know, long shares and short shares, we're going to do it with a synthetic long and a synthetic short. So it's a really great way, very efficient, utilizes your capital. You know, it's the same basic, you know, when you're doing synthetics, you're basically doing the exact same thing as your underlying. All right, so totally mimic that security that you're trading, but it's going to do it on a lot less capital because you're using options to create a pairs trade. So it's a really cool thing. And then the thing you can do is, let's say, you know, if you were doing stock long, stock short, or something like that, it could take you, you know, several $100,000 of capital tied up, right, to do long stocks or short stocks. But for the same position size, you could do it with synthetic options, and it takes a lot less capital. So then you could take the excess capital that you have left over, you know, invest it somewhere else. So you're, you know, utilizing it better. So it's going to give you a lower cost. And the other thing it does is, if you've ever shorted stock, you have to borrow shares. Sometimes it's hard to borrow. So it ends the hassle of having to borrow shares, is the other really kind of nice benefit for a synthetic short. Now, before we get any further along here today, so we'll keep going here with the workshop, but I just kind of want to show you what's going to be happening next weekend, next Saturday, December 6th. So I'm going to really be doing a very in-depth course on pairs trading. Today is just kind of giving you a taste of what, you know, we're going to be looking at, how it works, to show you some good examples. But then next weekend, we're going to get into it and really deep dive into it. So use this link here if you'd like to join along with me next weekend. And this is going to give you, I've got kind of 2 different packages. And if you pull that up, you can either copy it or copy it and paste it, or you should be able to click on that link. And once you click on that link, it's going to bring up, you know, these 2 different or 4 kind of different payment packages or options that I have. So we'll go through those here briefly, and then we'll continue on. But I'll show you exactly what you're going to be getting next weekend in the price. So overall, put that link in. It's powercycletrading.com/special. Copy, paste it, or click on it, and then you're going to see I've got course package 1. And with course package 1, there are 2 different options. Okay, so first, I've got a really good indicator that is going to be part of the course we're going to use. It's my cycle reversal momentum indicator. And so with, you may already have something you like to use. So if you don't want my indicator, you can have course package 1. This is option 1. This is the live course, okay, 3-hour plus course. You know, you'll get all the course material, everything live and recorded. Then you've got a 30-day trial membership to my trading club, which we'll talk about a little bit later. Also, Access will do a follow-up live Q&A, live and recorded, and then you'll also get another option, a tutorial. My option, not my option, this should be futures trading tutorial. You'll get that. So this package here is $197, but today with the 15% discount, it's $167. So here's the difference. So here's course package 1, that option. But if you want my stock reversal momentum indicator, which is $397 on my website, this is part of the, this what we'll be using in the course. This is part of this course package 2. So just for extra 32 bucks, that's all I'm talking, maybe 2 cups of Starbucks, you can have this course package here. And today with the discount, it'll be $199. So when I go out to my members and clients next week, it'll be $234 for today with that 15% option discount. It's $199. And so to get the discount, you just put in pair small cap PAIR 15, whichever package you want. So if you want this one, option 1, put in pair PAIR small cap. Remember, make sure it's small cap 15. Click apply, and you'll get this for $167. And then you can also add my, my directional trading indicators if you do want those. These are all available: Thinkorswim, TradeStation, Ninja Trader, eSignal, TradingView. So that's course package 1, option 1. But then if you want my cycle reversal momentum indicator, you're also going to get my trial membership, 30 days, coaching follow-up tutorial, or live and recorded. This will be a coaching session we'll have following up the course on Tuesday. And then you'll get this should be futures trading tutorial here. So this is going to be a cost next week when I go out, will be $234. But all it's going to cost you today is basically that $167 plus an extra 32 bucks. So 50% discount, that's $199. So come over here, do the same thing, put in pair 15 small cap, and you can get this for $199. Okay, so those are the 2 options in package 1. Now, what package 2 is, all it is everything in course package 1 that I just went over, but it's also going to include my Trading Elite alert service. Okay, so you'll get this if you want this package. You'll get this, 2 of the 5 different trading alerts that I send out. You'll get these for the next 4 months, and then plus 4-month membership to my trading club, which is, I've got the trading room. We do, all kinds of different things. We have membership trade room that's open, Wednesday through Friday, Q&A every Tuesday, and then access to, trading vaults, some things like that I'll go over here in a little bit. But here's just a quick overview of the trade performance. If you're interested in this, we've had a really good success with this. I started the first alerts back in 2018, and now there are 4 different ones I send out now. But since inception through Friday, running still about a 79% win break-even rate. Okay, so we've had 955 trades, 679 winners, 71 break-even, 205 losers. So we're running this right here. These are unaudited, just a summary of win-loss. And then just for this year, from January 1st through Friday, we've had running about a 79% win rate on it as well. We were up to 85%, and then we had that kind of pullback, 2 weeks ago, and gave back a few, but really high win rate, break-even rate there. So 123 trades, 81 winners, 16 break-even, 26 losers. And they're very, very controlled trades. Keep the losses very, very tight on that. So if you're interested in my adding the alert service to it, then that's kind of what you're going to be looking at there. And then there's course package 1, which gives you what I just showed you, gives you the 30-day trial membership. Now, if you want option 2, that's where you get the momentum cycle reversal indicator. Okay, so the prices here are $597, which is basically just you're paying $100 a month additional for the alert service for over 4 months. So if you want this with the 50% discount today, this will be $507. Okay, so $597 is the price that I'll go out to next week. But with the 15% off, today it'll be $507. This comes with those bonuses I showed you earlier, but no cycle reversal momentum indicator. And this would be with the cycle reversal momentum spread indicator. Today will be $539, just an additional $32. And there are 2 payment if you want, okay? And so that's kind of, a quick summary. We'll go back over this in more detail here in a little bit. But basically what you're gonna get if you do the alert package with it, typically 8 to 12 stocks or ETFs per month. And so there'll be text alerts. They could be, based on what the market's given us, they could be alerts on selective butterflies and long condors. We did a butterfly and a long condor last week on Amazon. Or it could be selective counter diagonals. We did a really good counter diagonal last week on Walmart. I'll show you this in a little bit. Or it could be a pinning trade, okay? So it could be what we call a pinning trade using butterflies or calendars, or it could be a selective earnings trade. So these are the kind of the 5 different types that I will send out, or it could be a breakout reversal, which could be credit spread. So that's kind of an overview there. And then I'll get through in a little bit more detail here a little bit later after we get through the workshop. Okay, so this will be for 4 months on all this, and you can stop and start the service whenever you want. You're automatically yourself. You'll see how to do that in your members area. Plus 4 months to my trading club. All right, so that's kind of what I wanted to go over real quick, and then we'll move on, and we'll show you this at the end of the presentation here today and take any more questions. So if you want package 1, which will be $197 this next week when I go out. If you want it today, $167. Use that special link and then use small cap. I'll just type it in here, PAIR, P-A-I-R, 15. Okay, so that's going to give you the 15% discount. And that's what you'll get today. And then if you want with my indicator, my momentum cycle reversal indicator that we're going to use in the course for the spread trading, this is just an extra $32. You can have that today. It's $199. If you want my 5 different alerts for the next 4 months, you can stop and start when you want. That's course package 2. Option 1 would be without the indicator. That'll be next week when I go out, $597. There is a 2-pay if you want, but today will be $507. If you want it with the indicator, just an extra $32. It's $539, okay? And there's a 2-pay. So in this one, you get 4 months of all 5 of my different alerts that I send out, 4 months of my trading club, and those additional bonuses. And if you do option 2, you get my momentum cycle reversal indicator that we're going to use for the spreads, okay? So I hope that was something to take advantage of for everybody here if you're interested in the course next weekend. And this is a fantastic course. I only do this, once a year, and then I don't go back to it. So, so that's where we are there. I don't have that for you, Stan. I just give my, overall kind of win rate performance. I'm not a trading advisor or anything. These are just alerts, selective trades that I send out. So just to give you an idea, because a lot of members do their own thing, okay? I'll send out, we'll talk about it a little bit more, but when I send out a trade in the alert service, I use a Telegram. It sends it out really fast, okay? So the trades that I send out, these are selective trades that I might see that, okay, and then I'll give okay, this would be a good trade. Use a butterfly, use a condor, use a calendar. But a lot of members to the alert service, they just want the trade idea and then they do their own thing. Okay, so it's just kind of just gives you something that you can trade off of. That's a really good high, probability selective trade that I see, and then lets you take it from there, and you can follow along and use the strategy that I'm using, and then I'm constantly monitoring the trade to tell you what it's doing, if you should adjust, get out, things like that. We'll talk about it a little bit more later, but that's kind of an overview of what it is. Okay, so let's take a look at what are suitable pairs determining correlation. So the first step is you want to find suitable pairs, right? So you're going to look for securities that have something in common, that are, that trade with a good liquidity, can be shorted. So, you want good liquidity because of similar market risk. Competing companies within the same sector make a really natural potential pairs and are a good place to start. Another thing too is, everybody here, you may have been working in a certain industry that a lot about, the companies within that industry. So which ones are doing well, which ones are not. So, that's a really great way to also pair trade, is based on the knowledge that of some industry and stocks within it that you can pair up, with others that are weaker. So these are, all things to be thinking about as far as determining what would be a good stock correlation or stock to pair. Now, the main thing is, the catalyst to trigger a correlation, the strength or weakness to trigger it, to, make it move, okay? So when you have two instruments that are highly correlated, there are going to be certain events that can cause, kind of temporary weakness in that correlation between the two. So, there are many factors that could make this kind of catalyst or price movement that could affect the correlation. So it could be a Federal Reserve announcement that really hits one stock versus another really hard, or the sector that it's in. Or another really great catalyst for these types of pairs trades or earnings, where you get a fantastic blowout earnings, like what we've seen with NVIDIA or Google recently, things like that create the catalyst for it to just take off relative to its peers or something that's correlated with it, or the sector that it's within, right? Now, these are the events that trigger this weakness or strengthening correlation are generally going to be limited to things that are, primarily impact only one instrument. And then you can pair it with something else that's, related to it. So for example, you could get a major divergence could result from a temporary supply demand changes within one stock, such as, just recently we had Warren Buffett buying 4.9 billion stake in Google, and that just exploded Google, right? And before that, Buffett had another great example, was he bought 4.5 billion stake in ConocoPhillips and Oxy, things like that. Those are things that can catalyst a stock to have a impact on the pairs relationship that you can pair it, with something else correlated. So for example, here's an example of just Conoco Phillips back when this came out. So you can see Conoco versus XLE, the ETF energy sector that it's within is XLE. So you can see here the correlation coefficient between the two is really strong, 0.985. All right, so this is a good example. So then, Buffett comes out, it's announced, okay, he bought 4.5 billion in Conoco. Wow, that really increased that spread in Conoco to start moving up faster than its ETF sector that it's within XLE. All right, so that's a really good, example of a catalyst that you can trade off of for a pairs trade. And then what I like to do is, also align my momentum indicators for the entry into that specific, potential pairs trade. So we'll go through that here in a minute to show you how that complements, something like this. All right, so that's an example. So here's kind of just looking at the math here real quick. So the macro trend catalyst of Conoco taken out or breaking out versus XLE. So at that point in time, ConocoPhillips minus XLE on the 20th of November, Conoco was trading at $25.39 per share under XLE, okay? So it was $25.39 per share under XLE. Now, on the 4th of March, you can see that was November, and then 5 months later, it was $1.85 over XLE. So it totally flipped, right? So a huge change in that spread, okay? So you can see here, this is what we're going to go through the course, how to set up these charts like this, where you're using these line charts to show you the spread relationship and how then to manage and trade the spread. So here you can just see as an example, you can see at that point right here on the 20th, that spread between these two share one share was Conoco was $25.39 trading under XLE. And then that news came out and man, everything just started ripping. Look how it trended. And then here it's just taking a mark here. Now at this point it's $1.85 over. All right. So this went from $25.39 under, $1.85 over. That's a gain of $27.24 per share. Now on 100 shares, and I do the 100 shares because the course I'll show you how to do this as a pairs trade using options. So remember, one option contracts equivalent to 100 shares, right? So just kind of make this apple to apples. That'd be a $2,700 increase. So from right here to here, if you did it with an option contract, you'd be up $2,700. That's on one contract. So, think about it. If you did, more than one, if you did 100, then you're up, 27,000, right? So something like that. That's, there's some huge, big money in that. And then the markets could be over this time could be, selling off, right? And they don't care because the pairs relationship is what the market, what this trade is looking at, that strength between Conoco versus XLE. So that's just a really good example of that, a pairs trade. So let's take a look at pairs trading opportunities and some more examples. So here's a, QQQ versus Apple. For the longest period of time, Apple was really underperforming the markets. So here's a good example of that underperformance based on a pairs trade. So these are, Apple versus QQQ, nice coefficient, relationship here, about 0.94%, very tightly correlated. All right. So then, Apple was really underperforming while the rest of the markets, QQQ was kind of going up. So you can see this chart here, just kind of showing you QQQ was having a pretty good, strong trend to the upside, right? Really trending nicely to the upside. Now, at that same point in time, you can see Apple was going up, but you can see, here QQQ was really taking off. But here you can see Apple, here was Apple at the same point in time. Here was long QQQ at that point in time. Here was short the Apple. You can see Apple went sideways for about 2 weeks, and then it started grinding up, but it was really choppy move up. But QQQ was, really having a nice trend to the upside. So here's that spread relationship as a pairs trade. So this next chart shows you what it looks like, that spread. So you can see right here, here's a daily time frame, and here's the 4-hour. And then these are my momentum spread indicators that we'll be using in the course. So you can see here, here's where that spread was right there. So it was about $150. You can see at that point in time, QQQ was about $150 roughly over trading over Apple. Okay, and then what happened? QQQ started to outperform Apple, and you can see that spread really trending up, really holding a nice trend up. And then you can see here, just taking a mark there. At that point, it was QQQ was $183.45 above Apple. And so, you just kind of do the math there, and that's a move of $33.45 per share increase from here to here, and times 100, that'd be, over a $3,300 move per 100, okay? From that point to there, that's one contract. So you can just see the potential of these types of pairs trades, the strength and weakness and the thing that you can, make off these types of trades. So that's just a kind of example here. Now, this is another one. This is a really a good one I like to point out. So back, when I was trading the energy markets and running a trading group, this is one of the trades that we would really look for every year. This would potentially make the whole year. So this is why I like to point this one out. This is what we call a kind of a crack spread. So this is also a pairs trade, but in the oil industry, we call this a crack spread. So this is when you're, the underlying the point, the crack spread is basically you're taking crude and then you're cracking the crude, creating, products, gasoline, fuel oil, distillate, diesel, jet fuel, things like that. So they call it a crack spread. So it's basically, though, it's a pairs trade. So here's just a good example of the potential these things have. This is on a futures pairs trade or crack spread, just to show you. So this would be going long RBOB, which is gasoline, and then short against it, the crude, which is the feedstock that you put in to make gasoline, right? So WTI. So look at this. So on the 8th of February, the RBOB was trading at $12.89 per barrel over WTI. So just a long story short, what you're going to do here is to make it apples and apples. When you're trading these crack spreads, this kind of spread, you have to adjust and convert RBOB into barrels of crude, which I've done here. So there's 42 gallons of RBOB gasoline in a barrel, 1 barrel of crude. So that's the conversion there. So you can see 42 times RBOB. So anyway, that was at that point, that relationship was 12.89. So RBOB was 12.89 over crude. Now, in April, towards the end of April, this spread blew out to 22.50 per barrel over WTI. So a huge increase. So it went from 12.89 up to 22.50. All right, so that's an increase of $9.71 per barrel. Now, when you're trading futures and oil futures, one futures contract is equivalent to 1,000 barrels. So if you were to buy one futures contract of oil or RBOB, you're basically actually controlling 1,000 barrels of physical crude. You could actually take delivery on it if you wanted. So just here's how then the math pans out. So in this example, so that spread went from here, 12.89 down here to 22.50. So that's an increase of 971 per barrel times 1,000. Okay, so one futures contract. So that's $9,710 if you did one futures contract of this crack spread. So these are huge trades. So just imagine that if you did this trade and you did that trade and you did 100 contracts, just if you did 100 contracts, you're up. This is why hedge funds can make such huge profits, or you could lose, but that would be over 971,000. If you did 1,000 contracts, you're looking at 9,710,000. So, these are the things that we were doing, and like I said, these can make your year. So, we would do 1,000 of these contracts or hundreds of these contracts, and if you got them right, man, it made your year. You're up 9 million, 10 million bucks really fast. So just to give you examples. So these are things that you can do with pairs trades, just to give you an idea of the other kind of areas that you can, trade. So here's just looking at it on just a regular chart, you can see here's the RBOB side here, really broke out hard to the upside. Here's the crude side. You can see it went sideways and then broke out, but it was lagging. All right, so that's a really good example of a pairs trade, or what we call a crack spread, RBOB versus crude. All right, so you could do this with distillate as well versus heating oil versus crude, things like that, or the other way around. You can certain times of the season you can short gasoline, be long crude. So just a lot of ways that you can do these types of trades. So let's take a look at some other, examples here. So here's kind of, offense, defense. Here's another example of QQQ long and the Russell 2000 IWM short. These are, good things to pair as well, the different ETFs together. And so here's an example, and this is dollar related. Okay, so the other thing that we'll go through in the course is how to make these dollar related. So you're not, when I was showing you earlier, it was just a one-to-one relationship. But if you've got something that's higher value, so maybe QQQs, going at $600, right? And the Russell 2000s trade at $250. we want to adjust this to make these more dollar equivalent to closer to 200. So it's just increasing the numbers to one side. So here's that relationship, making it more dollar equivalent. So this is going to make, yeah, if you're long one QQQ, we're going to be short 2 Russell to make it more dollar equivalent. Okay, so here's that relationship as a spread. All right, so at that point in time, this is that spread relationship. You can see my momentum indicators. Look at that cycle reversal, nice solid momentum, starts trending, breaking out. At that point in time, we'll go through this in a minute to show you the math. That relationship of long QQQ short to Russell was 76 under on a per spread basis. Now that spread then really had a nice move, and at this point in time, you know, about 3 months later, it was trading here at 1630 under. Okay, so a really big move, 76 under to 1630 under. So big spread blowout move between these two securities. So here's kind of going through the math so you can see how the spread works. So on the 6th of March, QQQ was trading at $302. On the 6th of March, the Russell 2000 was trading at 189, okay? Now, okay, so we're gonna make this dollar equivalent. So we're gonna do 2 Russell, okay, times 2. So that makes that relationship at that point in time on the 6th, this would be $378 and QQQ was 302, right? Now, looking at the math here, so on the 6th of March, it was here. And then on the 19th of May, QQQ was now trading at 336. So just looking at that move of QQQ into May, that was a $34.20 per share move to the upside. But we're going to be doing this as a spread in case the market's going down. We're going to take out that systemic risk. So on the other side of the trade was the short, the Russell 2000. So that was short at 378. And then on the 19th of May, the Russell was trading at 176, converting that. So that was 352. So you can see it went from 378, you were short, it dropped to 352.5. So you're up here 25.50 per share. Now, when we're doing spreads, we don't look at this. All we do is look at the spread. So here's the spread, okay? So it's real quick and simple. You can see at that point in time, 378 minus 302, the spread entry then was 76 under, right? Now, at this point in time, the 19th, now that spread was 352.50, 336.20. Now it was 1630 under, okay? So that spread then had that movement increase of 59.70 per spread, which per 100 is $5,970. Okay, so that's, you know, what we're going to be looking at. That's how you trade pairs. That's how you trade spreads, and that's what we're going to be, you know, looking at and showing you and teaching you how to do this in the course. And we'll do, and yes, you can do this with pairs, long, short, synthetic long on QQQ, synthetic short on the Russell 2000. So that's what we'll cover, you know, how you do that in the course. All right, so let's take a look at a few others real quick here, and then any questions, let me know. So here are a couple others you might be kind of curious. We were talking about earlier. Let me get my spread chart out here real quick. 1 second. Oh, man. Let me find that chart. Here we are. 1 second here. Here are a couple other examples, then we'll go through a couple more. Okay, so all right, so here's another just quick example. Here's like Starbucks versus XLY, which is the discretionary ETF that's within, right, the sector. So you can see this correlation is about 0.666, close to that 0.7. So here's just an idea of what you can look at, you know, as far as potential pairs. So here's like Starbucks minus XLE. Okay, so you can see Starbucks here. So this would be like you're going short Starbucks. And you see how that spread just decreased. At that point in time, Starbucks was $42 per share over XLE, and then Starbucks started really to fall off hard. And then Starbucks was then going at 70 under XLE here. So here's that relationship, that spread between Starbucks versus XLE. So you can see that huge move down. So here's that Starbucks really getting hit hard to the downside, and that's the perfect thing. Look at XLE going up. So this was a perfect pair, right? So Starbucks was going down, XLE was going up, XLY was going up. Perfect pair. Okay, so you could have been, long XLY, short Starbucks, or you can do it the other way around. You could be Starbucks short, long XLY, but same thing basically, right? So that's that spread relationship there. So just an example of that. And then here it is on the spread. So you can see it at that point, it was 58 under. Starbucks was $58 per share under, and it really got hit hard to the downside. Starbucks really had a big suffer, back a month or so ago. It's still pretty much under pressure. And then it got down as low as 85 under. Okay, so you can see that spread difference relationship. So that's a one-to-one. And of course, we'll look at, how to make adjustments if we need to and go from there. So here are a couple of just quick examples. Here's like Google, for example, versus the ETF it's in. So XL, the communication service sector. And this is on a weekly time frame. So you can just see the spread, how it blew out. Now here are the momentum indicators that I love to use for these spreads. And this is what you'll get as the tool that we use in the course. Okay, so if you do want this tool, it's just an extra $32. And so what you're going to get is the momentum cycle 1 and 2 and reversal indicator here. But look at this thing on the weekly time frame, long term. So you can see that Google is just for the full year. Here's 2025. Look at it; it was just really dogging it, right? And then look what happened. You can see that momentum shift. You can just see how visual it was. So hard down momentum, right? And then we had a cycle reversal right here, right there, and then we had momentum shifting. And look here. So if you're just following the indicators, you could have gotten in right here at 80, Google at $80 over XLC, right there, 80 over, if you did one-to-one. Now we're going to also adjust this for dollar equivalent, but if you just did one long Google, one share short XLC at 80 over, look where it is. That is huge. That's blowout, right? So that just gives you an idea of what can happen, what you can do if you get to find the catalyst. And so here is that same spread on the daily time frame. And let me mark it real quick so you can see. I mean, these things are just so exciting to do, and they're so much fun. So I'm going to mark this. This would have been right there getting in on the 9th of June. If we're just following momentum. So let me put that in. These are much more fun than just outright different, trading long short. Okay, so if you did that, that was right there. And let's line this up with the daily time frame to show you what that looked like. Right there. Now you can see the different cycle swings with momentum, but on the weekly, this is a super strong trend. This is the 8 exponential moving average. It's just tracking that down to 21. Just stay with it. A lot of different ways you can play stops. You can, use stops using your moving averages, things like that. But you can see that huge move, that run from basically 75 over up here to 204. So that's one relationship you could play. The other relationship you could play would be the same Google versus QQQ. So here's that relationship. obviously the sector that's within was the better, but here it is with, you know, QQQ. So it would have been getting in right about right here. And for fun, let's put in Google versus NVIDIA. All right, so you can see the swings here on the daily. That's why these momentum indicators are great. It shows you the swings. If you want to trade in and out, this is the way that you can do that. So you can see here, we had a nice momentum entry right here. See right there where my two momentum indicators were positive. And then you can see momentum starts to come off right here. Okay, so then momentum goes negative, okay? So then it pulls down, so you're just out. And then you can see momentum starts to just chop around here. So it's going sideways right there. And then momentum starts to shift again, and off she goes. All right, so that's your typical way you can, play that. Here's just for fun. Here's Google minus NVIDIA. Look at that. Took off like a rocket right there. Yeah, amazing possibilities. Yeah, like SP said, amazing. Yeah, I scan. We're going to go over scanning for these pairs in the course. Okay, look at that. So it's a really fun, exciting, and like I said, a lot of people that I've introduced this to, this is all they do are pairs. But it can be a nice addition to your portfolio, right? So you can do this and be a nice addition to what you're already doing. Oh yeah, here, Charlie, here's that link. Use that link here, powercycletrading.com/special, and then put in PAIR 15 small cap, and you can get the discount on whichever package you want on that. All right, so then how do you bring all this together in order to capitalize on this market neutral trading strategy? Well, that's where we're going to do it and take this up to the next step next weekend. So use that link I just gave you, and then take advantage of the discount. And next weekend, we're going to get into this in greater detail on how to pair trade, the pairs trading mastery, profit without predicting direction, the ultimate market neutral edge. So this will be next Saturday, the 6th, 11 to 2 Eastern, and then we'll do a follow-up Q&A dedicated to this on Tuesday, the Tuesday after on the 9th. And so then again, if you want to join me, again, we'll only do this typically once a year. Use that special link, and you're going to get here today for course package 1. Option 1 is $167. And so join us for the course for a low cost entry right here for $167. So with that, 84% off, the time I spent on the course putting it all together. But you're going to also then get some extras. You're going to get 30-day trial membership. You can start when you want into my trading club, which gives you access to my trading room, some other really good benefits there. Good question. Length of time on a pairs trade. These can be very long term. Let's just go back. That's a great question. Let me just show you. Just for example, they can be very, very long. So let's just, for example, once you get the edge, you just stick with it, right? So here's a really good example that we just looked at. Google within its sector XLC. Take a look at this. Question is, how long can these last? You see this one, for example, just get in right here. This was in June 2025, and here we are in November, 6 months, 5 months, right? About coming on 6 months. And they can be longer than that, you know. I mean, you know, they can be, you know, trends that last a year or even longer. And the great thing that if you did want to add this, it's a great way because then you're hedged against that systemic risk, right? So let's say you're long Google and the markets fall apart. Well, Google's still going to outperform based on this Google strength until that correlation, or until Google shifts its momentum, okay, until it shifts its momentum, Google is going to be outperforming XLC, right? And even if the markets are coming down, you know, you're still going to probably be making money on Google. You're going to be, you know, Google could be going down, but XLC could be going down a lot harder and faster, okay? So you're just playing that spread relationship. You can use long-term options. Yes, you can use leaps. So yeah, for these types of trades, it depends on the setup, but yeah, for Google would have gone out and used leap options, would have probably gone out to, you know, February, March, you know, just have to look at it at that point in time. But yes, probably would be using leap options, long, short. All right, so that's course package 1, option 1. You know, sign up today and you're talking just, you know, low bar entry, $167 today. And so you'll get the 30-day, the course live and recorded starting next Saturday. We'll follow up with the Q&A on that course the Tuesday after, and then you'll get 30-day trial membership to my club. You can start this, you know, as soon as you buy this or after the course, whenever. So you have a 30-day. Now, hopefully you'll stay on. If you do, it's $97 a month. I have other packages as well. And then we'll do a follow-up Q&A, okay? And then you're going to get my futures trading tutorial as just a kind of additional extra for this. So that's course package 1, option 1. Now, I'd highly recommend for 32 bucks, you know, it's not going to break the old lunchbox or, you know, your lunch money here. For an additional 32 bucks, you're going to get my cycle reversal momentum indicator. So, you know, so that's 397. If you go to my website, my indicators are actually over that. I don't even have this indicator on my website actually. And then you're going to get the trial membership, follow-up Q&A, and the futures tutorial. But I would highly recommend you going with this package for $199. And with this, you're going to get this really great indicator tool package, which comes with the cycle reversal, momentum cycle 1 and 2, which we're, you know, talk about in the course. This is a fast momentum. Momentum 2 is a slower confirming momentum indicator, and just a great tool that I put together for, you know, trading these pairs. Now, you can also use this for just, you know, any stock, just individual stock or whatever as well. All right, so you get that for, again, highly recommend you spend that extra 32 bucks. I wanted to make it as cheap as I could, but the reason I have 2 packages, so many members would get confused and say, well, why don't you, you know, give me this, give me that, but, you know, I'm just going to make it real easy. So just an extra 32 bucks, and today 199. Now next week this will be, you know, 197 is the price that'll go out for course package 1, option 1, and then, you know, today that's 167. But next week, you know, after today, after the discount's gone, this will go up to 197, and this will go up to 234, which is still a great deal. So if you want it for that extra 32 bucks, I would definitely jump in there today. And so that's course package 1, option 2, to make it kind of as clear as I can. And then if you want the alert service added to it, all right, that's going to give you my 5 trading alerts. Okay, so it can vary on what I send out. You'll get this for the next 4 months, plus access to the trading club for 4 months. We'll go through what that is, and then everything in course package 1. So either course package 1, option 1, which is no momentum indicator, or 2. So I've got the 2 packages, you know, for that. So these are trades that it could be a butterfly long condors. Like I said, we did last week, we did a butterfly on Amazon. We did a condor on Amazon as well. Or it could be a calendar diagonal. Last week we did a calendar diagonal on Walmart. Or it could be a monthly butterfly pinning trade. The week before we did a pinning trade on the Russell 2000. Or it could be a breakout reversal credit spread, or it could be a selective earnings trade. Okay, so there are 5 different types of trades that I'll send out depending on, you know, the market condition, what I'm looking at. Now with that, you get those alerts, okay, and then you're going to get on top of that course package 1. So that will be either you want it without the indicator, which will be, you know, $597 next week. Now today, without the indicator, if you want this, and there's a 2-pay, it'll be $507. If you want this to include the, you know, those bonus extras plus the indicator, just an extra $32. Today it'll be $539. Okay, next week it'll be $634. Okay, now with this, you're going to get for the next 4 months, and you can stop and start. You know, if you go on vacation or business trip, you can't be here, or you want to, you know, put the trade on pause for a bit, then you can start back. You're not going to lose your time. So with this package, you get all 5 of the different alerts that I potentially could send out for the next 4 months, plus access to my trading club, which gives you access to every Q&A that we do weekly, access to my video newsletter every day after the close for the next 4 months, access to my virtual trading room during the week for the next 4 months, and then 50% discounts on anything on my website, all courses and trading software. All right, so that's what you're going to get there. Hey, thanks, Sanish. If I may pass that on, appreciate the comment. Thank you so much. Pass that on. So that's what you're going to get there. And thank you so much for putting that out there. All right. Let me get rid of that drawing tool 1 second here. And then here again are the you know, summary results. These are just unaudited, just a summary of kind of win-loss, break-even. So for this year, you know, again, 123 trades closed out. Out of those, we've had 81 winning trades, 16 break-even, 26 losers, 79% win break-even rate. Again, unaudited. These are just selective trades that I send out. You can take them or not take them, and just gives you the trades, and then do it your own way. Or I always send out a specific option trade. I'll show you here in a minute. And then I monitor and keep you adjusted or keep you apprised of the trades throughout the day during the week, and any adjustments that need to come up, I tell you. So I'm constantly monitoring, so you don't have to monitor something that you don't have to be watching, staring at. So I started sending out my first alert back in, wow, 2018. And then I've added, you know, the other alerts to it. But so since the inception through Friday, 955 trades closed out, 679 winners, 71 break even, 205 losers, high win rate, win break even rate. And I keep my stops tight. You know, I want to keep these trades really on a tight leash, and then we do adjustments if we need to. All right, so that's everything there, just a summary. Now, here's just a really nice comment from Lee. She said, "This was an amazing course, Larry. This stuff I had no inkling about. It's like a graduate school course. Nobody else talks about this kind of trading." So, yeah, I'm not sure. Maybe, yeah, I don't know if anybody else out there is teaching how to trade pairs. Let me know if they are. I just kind of like to have an idea on that. But anyway, that's some nice feedback. Now, here's what we're going to cover in the course. There's kind of a little course outline summary. So we're going to go through how the pairs trading offers you really the safest way to generate consistent returns, whether the market's going up, down, or sideways. Okay. So then, you know, you're going to learn how to put the odds in your favor to take the worrying about the fluctuation of the market out of your trading by using pairs. So then what are the best strategies for pairs trading to take advantage of being market neutral? How to do that? How to identify and select the best pairs for trading, which, I've got a scanner I'll show you and we'll set up and show you how to use that. So for taking the scanner that I used for selecting stocks or ETFs to pair, or even futures. And what I like to do is use momentum for the entry exits out of these types of pairs. So we'll go through how to do that with the indicator that you'll get. Just for that extra 32 bucks, you're going to get a great tool here to use. And we'll be using this in the course, so don't get left out on that. So this is my cycle reversal momentum indicator that we're going to use. So it's a really good high probability setup pairs trading tool to use. Then we're going to go through in the course that how do you statistically measure pairs correlation. I'll show you the correlation calculator, how to set that up, how to use that to measure correlation. So we're going to go through how to do that as per each part of the trade. And then we're going to go through step by step, just kind of the process, to use that the hedge funds use that you can use too now if you do this pairs trading course. So what are the insider strategy? The hassle of boring. So that's how we're going to go through and do the synthetic long short. So we're going to go through and I'm going to teach you how, if you want to do the pairs, you can do it without owning the shares outright or having to borrow shares. And we're going to do it with a synthetic long structure using options and a synthetic short structure using options to put the spread on and take the spreads off. And then my own kind of proprietary trading formula that makes it easy to identify these pairs trades. We're going to go through what that is, how to scan for these trades. The scanning part is a really great thing to find and build your list of things to watch, and how to find the catalysts. What are the catalysts and what to look for there? And then my statistical resources I use for these pairs correlations and the pairs trade. If you want to, some other tools that I use. Okay, so there's a lot of good stuff that we're going to cover here next Saturday. Okay, sorry about that. Yeah, so we'll be sending that out to you shortly. Okay, but make sure to, if you want, take advantage of my discount on the course. Okay, so again, I'm talking to everybody that if you want to jump in for 15% off, here's the special link, powersoccertrading.com/special, and then use that small cap pair 15 and get the discount. But I'll highly recommend that you go with option 2 so that you get my pairs trading momentum indicator that we're going to use in the course. Just for an extra 32 bucks, we're talking $199 today. If you do that, I would highly recommend that, so you're not feeling left out. So use pair 15. It's a great tool, and then you can use it for all your trading. Okay, so use that. Now, just another thing that really, research shows that we can learn the most from experience, not just study. So by combining this comprehensive course that I'm going to be doing next Saturday with the additional support provided by me, then you're going to be able to really get your trading to a new level. So I hope you'll join us, and let's go through the enrollment bonuses real quick and then take whatever questions you have. So I highly recommend, again, that you go with this package here, get my special cycle reversal momentum indicator. So we're talking just an extra $32, okay? So today, if you do option 1, just the course, it's $167 plus the membership, etc. But if you want this indicator that I'm showing you here for just $32, we're talking $199 today. You're going to get this tool, which is just going to be an invaluable tool for you for spread trading, just for all your trading in general. So you get this indicator, and I've got this available for Thinkorswim TradeStation Trading View. Okay, and so this it'll be my cycle reversal indicator, and then my momentum indicator, cycle 1 and 2, which measures momentum strength based on fast momentum and slow momentum, which we'll go through in the course, how to use this indicator for setting these trades up. And then bonus special two, everybody will get this, will be a 30-day trial membership. If you do package one, you get a 30-day trial membership. If you do package two, you're going to get this for 4 months, but you'll get 30 days. You can start this when you want. And with this, my trading club, what you're going to get is access to my virtual trading room. So this is open from 9:30 to 10:30, Wednesday through Friday. Now I start the week off. Monday is usually kind of, a lot of times we call it Tuesday, turnaround Tuesday. So Monday, my alert service is open. I'm sending out alerts or anything that needs to be done there, but the trading room is closed. Then Tuesday, we start the week out with our live Q&A. So you'll have access to that. That's going to be at 10 o'clock a.m. or 11 Eastern. And then you're going to get that part of the trading club. And then I do a daily video newsletter every day after the close to show you my outlook of the markets, what's coming up, any trade potentials or trades that we're going to be looking at doing or trades that we've done. And then I do a members trading videos or archive. I have what I call a trader's educational vault, some nice educational material on there. And then anything on my website, powercycletrading.com, you get a members discount of 50% off. So this is any courses or software, you'll get a members code and you put that in and you'll get a 50% discount. Okay, so if you just go to my website, Powercycle Trading, I'll just pull that up, and you can see everything that I offer, and then anything that you want, you will put in that promo code that you have your members code once you're a member, and you'll get 50% off. So if you want any of my additional trading software, you can see my scanners, all my different indicator tools here, whatever it is you might want, you come in here and just go to the link, payment link, and then, add to your cart, but you're going to get a members code that you'll just put in there, not 50% off whatever that price is. So that's on anything on my website. So it could be the software that I have. I've got a lot of tools there, or it could be any of my trading courses, option. I do a lot of option courses. So anything here that you might want, synthetic options, breakout trades, butterflies, calendars. So here's my calendar course just done recently in September. If you want that, come down here, you see what it's all about. $397, you put in your members 50% discount, it's going to knock that down in half, okay? So that's a big benefit there that you'll get. All right, and so this is one thing I always like to point out too. This is from one of my good members, Jay, and this is so true. He says, reading books is fine, but seeing the actual option trade or trade setup makes a huge difference in your trading. So that's, what you're going to get out from coming in the trading room and ask questions and see what we're doing there. And then we'll do a follow-up Q&A on the Tuesday after the course. And then plus remember, you'll get 30-day trial membership to the trading room. So you can come in and ask questions there, or hopefully you're going to continue on. And then you're going to get my futures trading commodity guide. So you'll get this all about futures, which will be very helpful too if you're interested in trading futures. You'll get that. The Q&A on Tuesday will be at 11 Eastern, and it'll be live and recorded. Okay, so if you can't make it. And then here's just kind of go through my alert service. So a little feedback here is from one of my alert members, Dan. He says, you're very diligent and totally thorough with your analysis. That is the foundation of the success of alerts. He said, and this is what a lot of members have done. He said, I paid for my subscription with the first 4 trades I took with you when I was just learning how to trade options. Please feel free to share this with other participants. And then Scott said, it'll be the best investment that you'll ever make. Go with the elite package, great group of traders. So this is what you're going to get. Now, when I send out alert, again, like I said, a lot of members just want to see the trade setups that I send out. But when I send it out, I'll also always give you an suggested option trade that I think is is appropriate for the trade. So that will come with the entry level profit targets, using what I call my price target mapping, which I also show you the target. Usually what I'll do is give you target 1, 2, and 3, and then we target those for our profit take areas. With the option trade that I sent out, I always give you the option series to use, the specific trade, stop loss level guidelines. Trades are listed in archive, so you can go back and look at them. All right, so that's kind of a summary there. Then that day after the close, I will do a setup video review of the trade, why I put it on, give you a little bit more background. I do that daily video newsletter, so kind of every day after the close, kind of give you my overlook or overview of the markets, what trades we're looking at, what's going on there. Then we do that weekly Q&A every Tuesday, live and recorded, 10 Central or 11 Eastern. Access to the virtual trading room Wednesday through Friday, and this should be 50% discounts on everything. So here's some alerts that we've just recently done, just to give you an idea of what they look like. So this is a breakdown of my calendar diagonal alert service. I set this up and started sending these trades out back in June of 2019. And this is through Friday. We do a lot of these types of trades. We've done 386 of these trades since this inception. 271 winners, 28 break even, 87 losers. Win-loss break-even rate 77%. Again, unaudited. These are just a summary. And then here's the trades, what they look like. And this is using what we call a Telegram, which is a really fast, free service that we use. This is one that set up last week on the 25th. So this was on Walmart. It's trading at 105.50. You can see this is what was sent out to every alert member. So I go here, new Walmart long, trading at 105.50, okay? So this was sent out with just as soon as I tapped the enter, boom, this went out. Now you can have this by text, or we can also give it to you by email, which is going to be slower. Now definitely sign up for, I would go with option 1 or add 32 bucks, okay? So this was the trade. So we did this calendar diagonal. So it says buy, and you get a cheat sheet. It tells you exactly how these trades work. Okay, you'll get that so you understand this lingo I put in here. So it's saying here, buy the 12 December, sell the 28 November, 105, 107 call calendar spread at $1.95. It says around. So, you might get in $1.95 or better or around that, okay? So then here it was on the 26th, and here it was on the Friday. So on the 26th, did an adjustment, all right? So you can see here, Walmart trading at 107. If long that spread, make sure you took some profit and adjust balance. So we did an adjustment here. We rolled the short strike, we bought to close the 107 short, and we sold to open the 5 December 110. So we did an adjustment there, and then ended up long the 105 short the 110, 5 December, and then here was some profit take. We did a big adjustment on Friday on Walmart. So what we did here was we locked in a big fat profit, sent this out. It was trading at 109.80, and it says buy to close the 5 December 110 short call that we had on. And then it said sell to close the 12 December long 105. So we had a big profit in that we took. And then what we did, we adjusted it. So then we bought the 12 December 107 call, rolling it up, higher strike, locking in big profit there, and then sold against it the 5 December next week, 112. All right, so that's what we did. And then, you come in the trade room, you ask questions about any of these trades, and I go through and explain it. So here's that trade that we did. You can see here is the setup. This is a 4 hours, so you can kind of see what I was looking at. So we got in right here. See the momentum, cycle 1 and 2. Got in right there, boom, exploded up. We did an adjustment up here, and now I'll show you where we are on this trade. So here's the adjusted calendar, call calendar diagonal. So now we're long the 12 December, 2 weeks out, 107 call, and then short against it the next week's expiration, the 5 December, 112. So we've got this nice $3, $4, $5 wide spread at cost, adjusted cost of $1.74, 174 bucks. And that spread went out blew out to 357 on Friday. So now we're up $183 per spread, one spread, 105% return. Okay, so that's on one spread. If you did 10, then you can kind of figure out where we are. So that's a look at one we just recently did. Here are a couple others, just kind of give you an idea of what you're, can be looking forward to getting. Here's one that we did on Dell, and this was a trade entry on the 22nd of October, trade at 150. I'll go through these kind of fast so you don't have to kind of sit through it here too much longer, but here's where we set it up on the 22nd. We did, it says aggressive long, and this because we did this off a 4-hour time frame. Anyway, so we did this trade, another diagonal. I'll just kind of go through this kind of fast, but and then we did an adjustment on the 23rd, and then here it was on the 24th. So you can see it went from 150 here. Now we're trading at 158.95. And we adjusted this trade into, I believe, a call condor. So here's the trade. When we got into this trade, it was right here. And out right there, just, in the 22nd and out the 24th, in and out pretty fast on that trade. So these are, most of them are kind of short-term swing trades, anywhere from 2 to 3 days out to, 6 or 7. And then here's the kind of initial trade setup was on the call counter diagonal. You can see on this, at this point, went in 150.40. Then on the 23rd, a day later, it was trading 153.62. So the spread we had on was at 330. It blew out to 417. We were up 87. But we did a really great adjustment on this. And now, the next slide, you'll see we adjusted this to a call condor and really reduced our risk down to 0. Okay, so this is another thing that we do a lot of that you'll learn in the trade room and in my courses. But now we adjusted this on the 23rd to a long call condor, and we were able to do it into free risk, take off the total risk. So now we were long the 152.5 call, short the 155 call debit spread. Then we sold against it, reduced risk, reduced data. The 165, 167.5. So now we had this on at actually a credit of $15 right here. So we had no potential loss, potential to make 265 on a credit now from the adjustment of $15 in our pocket on a credit. So here was the trade, took it off right in here. Wasn't max profit, but pretty decent. So you can see the spread went from a credit of 15 to blew out to $130, so up 145 on 0 risk on that trade. So that was pretty cool. And then here's just one more. This was on Gilead. We set this up on the 7th. I'll just kind of run through here pretty fast. We did some adjustments here and adjusted this into a free trade as well. So here was the trade entry right here. Really nice setup right here. This is what we call a volatility squeeze. See, my momentum indicators got in right there and then had a nice trend up, adjustments here, out here. So in at 115.60, and then profit take out on the at 123.85 and on the 22nd here. Right, just kind of give you a flavor of the trade. So did this trade initially call counter diagonal. Here, the spread we got on for 284, blew out to 408. We're up 124. Then we did that adjustment and adjusted this into another call condor. So this was adjusted on the 17th, and now we're long the 119, 124 call debit spread, short against the 127, 131. Credit spread is called a condor, and we adjusted this into a free trade, $30 credit. So no risk, potential to make 530. And right there it goes out. So that was where it was going out. So the spread went from, we had a credit adjusted to a $30 credit. Spread blew to 374. We're up 404 per spread. Or, like I said, a lot of members just do their own thing. So they may have been just long calls or whatever. So that's kind of a look there. Now here's we do a lot of these butterfly and condors. These are the other kind of sector of things we do. So I started this service back in 2019 as well. We've had a really high winning rate of 80%, 241 trades closed out, 172 winners, 21 break even, 48 losers, high win rate, break even win rate. These can give us, these are really tight trades. These spreads are really low risk. And I mean, potentially you can get, 25 to 1. I mean, we've gotten close to that where, 1,000% returns on these things. These are sometimes can be incredible. Here's one that we just set up. This was a butterfly that we set up this last week. And some of the members stayed in it. I set this up on the 25th as a butterfly. And then, it was kind of wobbling around. So I sent out a note to get out at break even to a little profit. But, like I said, a number of the members stayed in. So here's the butterfly that we set up. This was on the 25th. Amazon was trading at 229.70. And then on Friday, this was a really short-term trade just last week. It was trading at 233.11. So this was a kind of a low, very low risk butterfly trade setup. You can see here's the trade entry on this date here, the 25th. And then here it was on Friday. And then we set up another trade with Amazon on Friday for a condor. So here was the butterfly that we initially set up. This was the 230, 235, 240 call butterfly, $5 wide, $121 of risk. So potential to make $500 wide spread, less that potential to make 379 or 300% return. And this is where that trade went out on Friday. It actually turned out really well, the butterfly right there. So it went from that 121 out to 318. So it was up within 3 days, $197 per spread, or 162% return on that. And then we did a long condor here on Friday. I don't have that. This was a long condor that we did back in July. I'll just kind of run through this one that we did, long call condor. And this one worked out really well also. So this went from a spread of $105 to 248, so up 143 per spread, or 136% return on that. All right, so just a few of the trades that you can be looking at potentially to be, seeing these send out. And then I'm constantly monitoring these trades and, sending out whatever adjustments might need to be made. And then these are some of the, we call it our lotto trades. So this is where, you can just really, we call this lotto tickets because the risk is so low that it's kind of binary, either lose or you make money. If you make, it's going to be typically a big winners, but these are very, very selective. Don't do a lot of these, but when they do go out, sometimes they can be really big. So this is one that we did on SPY, a butterfly. So we set this up. It was trading at 573.80, and we were looking for a move potential pin up to 560. So set this up on the 6th, and then on the 10th, this thing was trading from 573. Now it was up to 561. And the butterfly that we set up was now up $232 per spread, 595% return. Okay, so we set this trade up as a butterfly for a risk of $40 or less right there. So this is what, a penny kind of binary trade. So you risk your debit paid. So got in right there on the short side, and we were looking for a target down here, this 560. And then here's the trade profile of the trade. So this was then going long a put butterfly, 565, 560, 555. Cost of the trade was $39. Risk of that 39 cents, $39. $5 wide spread less your cost. Potential to make 461. If you got the perfect pin, that'd be over 1,000% return. So this was one that we did pin almost to the penny. Look at that. So this one went. Now we're getting out. These are scaling out, but at the very end of the day, this thing was right there, almost nailed it perfectly. So it was trading right there at 560.32. So you can see this was The spread was 565, 60, 55 on the butterfly, $39 of risk. And so it blew from 39 to 456. That's $417 for one spread, 417 or over 1,000% return. So that was a really cool one. This was one that was unbelievable. This was on Tesla. This was one that we did back some time ago, but this, just to show you that we set this up for, I think it was $12. So we set this butterfly up, 197.5, 200, 202.5 call butterfly for 12 cents or 12 bucks, okay? So this was on the 8th of February. It was traded at 189.35. And then here it was on the 16th at expiration, pinning almost to the penny, or I think it did pin to the penny. It was up $231 per spread on that risk of 12 bucks. It was up over 1,900% return. So these are, very selective, but sometimes we'll hit one, the lotto, we'll hit the lotto. So there it was. Here was the trade setup, the profile. You can see 197.5, 200, 202.5. Cost of the trade, 12 cents, 12 bucks. Spread width 250, potential to make 238, 1,983% return. And this one nailed it perfect right there. So that was amazing. So it went from 12 bucks to 250. So it's up $238. 1,980. Again, we're scaling out, but right there at the very end of the day, that's what happened. All right, so that's kind of what you can look forward to. And again, I just want to say thanks for everybody being here. I'm looking forward to next Saturday. It's going to be a lot of fun. And put that link in there, powercycletrading.com/special. Put that in it, and then put in that small cap pair, PAIR 15, and get that discount and join me. So for today, it'll be 167. Again, I highly recommend you add that 32 bucks and get the indicator that we're going to use. And today it'll be 199. Okay, so this is course package 1, option 2, and that's everything you get. So you'll get the cycle reversal momentum indicator, 30-day trial membership, the follow-up Q&A, futures trading tutorial. So a lot of value there. Today, 199. And then if you want the alert service added to it, got the same 2 packages. You just do package 2, option 1 is 597, but today it's 507. So next week I go out with this package, it's 597. There's a 2-pay if you want it. So it's 507 today. Now add that 32 bucks, and for today it'd be 539. You get all 5 of the alert services, start and stop when you want. 4 months the trading club, 4 months of the alerts, plus the course live and recorded, plus those extras. And that's everything you're going to get there. Okay, so just take your time. If you have any questions, let us know, and look forward to working with everybody here. And again, thank you so much for being here on this Thanksgiving weekend. Any other questions, let me know. Other than that, we'll call it a day. All right. All right, thanks everybody. Have a great rest of your day, and enjoy the rest of that turkey and dressing. Okay, ciao.